Hi everyone, this is Ben, and today I'm going to be talking about Fibonacci retracements. We're going to take a look at how to draw them and how D and I use them to find targets. Yeah, the concept of the Fibonacci is pretty straightforward. Any major move has the potential to retrace a certain percentage. Now, there's a fancy mathematical formula that can be used here called the Fibonacci golden ratio. Has to do with a bunch of complex math. Some mathematician in 1200 BC saw a conch shell and came up with this relationship. So we've got a basic formula here. The important thing to note is you get this 618 number that keeps showing up again and again. And from there, we're able to derive a series of numbers. It's basically 23, 38, 50, 61, and 78. So we're going to take a look at how you can draw these on your charts and why these levels become important. So here are Fibonacci's on 3 different platforms. I've got ThinkOrSwim, Fibonacci Trader, and SierraChart over there. And I've got some of the levels preloaded. Configurations are a little different. They're always going to look different on different platforms. So here on the left, we've got the ThinkOrSwim platform, which is pretty straightforward. You can see the retracement actually goes from the bottom to the top. And a retracement of this move, if it went 38% backwards, would be down to this level at 1320. Now, D's preferred platform, which is this Fibonacci Trader, is a little bit more Spartan and difficult to use until you get used to looking at it. So you can see in her thing, there actually is this drawn area here, but for simplicity's sake, it's only drawing that line. It assumes you know what you're talking about. Same thing with SierraChart here. I've just got some numbers here. And you can see I drew from number 1 on up to number 2. And so a 38% retracement comes down to 1320. A 50% retracement, that's also known as the halfway back, it would be, this 1309 area, and that's halfway between this bottom and this top. It's really not that difficult a concept. The trick is what to do when you start seeing these things. Now, what ends up happening is people draw these things in all kinds of crazy ways, and there's different arguments about how to do it. The thing to remember is 90% of the market is computers. It's algorithms. You're trading against a math program. So you think like a computer would. A computer is going to look at extreme highs over X number of bars and extreme lows over X number of bars and do the calculation based on that. So in the picture here, you can see that we have a nice little downward move from up here at this 1412 area on down to this swing low. And now an argument could be made that the way that I drew this is wrong because it's not the very, very low. Well, if you imagine for a moment that we haven't seen these bars in area 1 yet, when we start to see, 4, 5, 6, 7, 8 bars all in a row going the other direction, you possibly have a retracement in effect. You can see in this case also that at point 1 here, we do have a retracement exactly to the 38 line. So if you were looking for that area of pullback to sell, to hop on this board, you're sitting here on these bars at May 21st, and you're going, man, there's no way I can sell this thing this low. I really need a pullback. Oh, I could sell this doji, I guess, but I don't know. It's the first attempt up. What is a reasonable area of a pullback when they're going to find new sellers who are waiting and for their opportunity to really get into this? And one of the areas would be that 38% retrace. And you can see exactly what happened. We moved down. We came up to 38. It's in the middle of nowhere. There was congestion up here at 49 and 50. We're nowhere near that. So why did we kind of top out right here? Well, the answer is a lot of computers use these daily bars and Fibonacci retracements. When they saw 38% pullback, they decided that that was a fair amount to pull back, and they started selling again, looking for equal or new lows. So when it pulled back here, it hit a wall, and you can see boom and right back on down. So the next piece of this is when you see that resistance right there where it bounced off of that area, you kind of get excited because you know that the bears are in charge, you know the sellers are in charge here, and the opportunity is to get down to a new low. So you're looking for it to come at least down to this 87 area, and with any luck, you'll actually get a Fibonacci extension, which goes beyond this thing all the way down to 123. So, you know, that's just another Fibonacci number on the far side, and that's one of the targets that we often use. If you're trading in this space and you're trying to figure out, well, where are we going? You can see we haven't really been in that area for a long time, so looking left isn't a good enough answer. How do you come up with a probable target? You come up with something like this, and you go, well, you know, maybe 58. It seems like a pretty reasonable extension. And you can actually see that the low was 12.62, which was $4 off. Now, you go, oh, well, it wasn't exact. It's not perfect. Well, nothing's perfect. And more importantly, when you were trading 13.36, to be able to predict a move that was, you know, what was that, almost 70 points away within 4 points, that's a pretty good horseshoes and hand grenades equation for you to start looking for a place to really tighten those stops and start taking profit. So that's kind of what D and I are using these Fibonacci's for, is because when we're sitting on this bar and we don't know what to do, we're excited to join a trend. We see a big monster trend, but we know that we don't want to sell the low tick of the swing. So we're looking for a pullback, and we're looking for that 38 as our first level of resistance. And when we see that resistance bouncing right off that 38, we get excited, and we're going to sell into that momentum, and we're going to be looking for that Fibonacci extension. So here's an example of it happening in real time. Here in June, we've got a move coming up here where it's pushing up through to this first level. So you can see we drew from the low to the swing high. So, you know, I'm not drawing from over here. I'm drawing from the lowest low and all the way to the highest high. And if I'm sitting here going, you know, this thing, this might bounce right here. This is exciting. I want to buy, but I'm not going to buy the high tick. I don't want to be the jerk that buys right in the middle. You know, why would I buy right here? And the answer is, I mean, you could, but what a lot of people will do is buy a very small piece right here, but then they'll hold the majority of their trades for a reasonable pullback. What is a reasonable pullback? Well, the 38%. Boom, look at that, right to the 38%. We find a nice pocket of buyers, and boom, jumps right back up, $12 bar. You know, this is an area where you could buy. So that's kind of that's basically how you draw this, because you have this 1320 line drawn on your chart as soon as you start to turn down. So you're hoping, I mean, who knew it was going to happen in one big bar? But if you're sitting here wanting to buy, you're looking for this, you know, 2024 area as a buy zone, and sure enough, it comes down and goes right back up. So let's look at the another way of using these things. Now, John Carter, who's wrote a bunch of nice books on technical analysis. Well, one of the things he talked about a lot was the ambush zone. This was one of his favorite things. You know, it was real popular back in the 80s and 90s, the ambush zone. So what you'd have is, if you have a big down move like this from point 1 to point 2, John's premise is that between the 50, which is the halfway back line, and the 618, you have this yellow area called the ambush zone. And a lot of times when you have a pullback, you actually have a pullback into this area. And then this is where the buyers or sellers have their final fight. And one side or the other is going to capitulate based on what occurs during that fight. So this is the ambush zone. If you're a seller and you're looking to sell real value or a deep retracement, you're potentially holding out until it gets into the ambush zone. So you can see that prices actually, they come way down, they come back up, they test into the halfway back zone. That test is sold real quick. We gapped up into that, immediately sold back down, and we start grinding up again because they did not find the boogeyman sellers. Well, the boogeyman was up here in the 618 area, and as soon as they got up here, kaboom, you can see they tried once and then tried again and got that breakout back down. So if you were looking to sell on an extreme pullback, this is an area. When you see this doji bar right here, you start going, this is an interesting area. You can get short right up here near the top of these bars, and then you know where your stop is. Your stop is, maybe an ATR and a half above this bar, and you're looking for this 618 to become a strong resistance where it can't get a close above. So if you get a close above that 618, then you know that you're wrong and you just get out. But if you're right, you'll see maybe a probe and fail like what happened on this bar, or just strong resistance where it just can't get through it. And then right on back down, boom shakalaka, you're short and you know where your stop is, and you're taking some profits at the 38, and maybe you're looking for a 50, or maybe even a 618 going the other way. Why not? So that's pretty much what goes on with fibs. There's one more interesting side effect of Fibonacci's. The 50 level is technically not a part of this golden ratio, Fibonacci math, but it becomes a really interesting thing because it allows you to do something called the measured move, which is a 50% move that the computer algorithms use all the time in a lot of markets. So in this case here, what I've drawn is this purple arrow. Now all three of these purple arrows are exactly the same size. So you can see that in this first move down, let's say that you're sitting at this bar right here. You don't have any of this other stuff. So you draw this bar down. You're still short, but you're going, man, I'm feeling kind of greedy here. I don't know how much longer this thing could go, but we're going sideways. If we get a downside breakout, how far is this thing really going to go? Well, your fantasy target is a measured move, another half, this move, leg one, and then leg two down. And you can see it actually predicted it pretty close. You never know if that's a blow off overnight bottom or whatever it is, but again, considering you're 70, 80 points away, to be within $5 or $6 of the bottom, on a wild stab in the dark, that's not coincidence. That there's a reason that people are excited about fibs, and we look at them all the time. It's because they really work. The computers use them. The algorithms are tuned to trade for these things, and they're tuned to take profits when it happens. So I'll give you another example here. Here's this measured move again. We get that pullback to that 50% line, whatever it was. And in this case, if you remember back from this slide, it was this one right here. That was actually a 38% pullback. So, if you're a robot, you sold, and then you start getting the pullback. If you're looking to sell again, you sell at the 38. And then you're trying to figure out where to take profits. So you just resold 38. You could be using this 123 extension, but a lot of robots don't use that. What they use is this measured move. So the robots would have sold this pullback anywhere here, and you can see that pullback comes down one measured move, and then immediately everybody gets out. Everybody takes profits. The reason that a monster trend like this ends is because everybody thinks that it's gone too far. It's exhausted outside of its value area. You no longer have people that are willing to sell that low. And when you have no sellers, or your sellers start taking profits, then all you have is buyers, and price goes right back up. So you can see, there's a lot of ways you could draw these. But this is why we use the 50% line in our Fibonacci's, because that 50%, that halfway back line, becomes really interesting. If I were to short up here, I would be very interested to see what happens when we get back down into this 50% number. It's not a coincidence that you have halfway up in this big move is a big old mess of fight back and forth. It's because the robots bought down here and they pushed and pushed and pushed, and then they did a measured move and they all took profits 50% higher than that move. So when they got into this mess, they took that second leg right here, and that's what it is. So, and that's why you've got this congestion. It's the middle of the fight, and that's where they drew that measured move, that second leg from. So hopefully that gives you a little bit of sense around Fibonacci's. One of the reasons that we wanted to talk about these explicitly, D and I especially will throw these around a lot just as a, when we're looking at in blue sky, when we're looking at white space and we're trying to figure out where could this thing go if it keeps going, we're going to use Fibonacci's. We also use these Fibonacci numbers, the mathematics behind it, you know, these 23, 38, 50, 61s. These become part of an input for the more complex Fibonacci pivots that we use to track the rolling pivots to come up with our day, week, month charts and some of the other price channels that we use as predictive stuff. So when we're talking about Fibonacci's, you'll know these are the numbers we're using. And again, who knows why they work as well as they do, but they certainly do seem to work. Thanks.